September 15th, 2008. Employees, carrying cardboard boxes, pour out of a gleaming skyscraper in New York City. They are crying. They are stunned. They are unemployed. This was Lehman Brothers, a 158-year-old financial giant. The Madoff scandal was $65 billion. The Enron scandal was $70 billion. The Lehman Brothers bankruptcy was $619 billion. It remains the largest bankruptcy in U.S. history. But this wasn't just one company failing. This was the single domino that toppled the entire global economy. This is the story of how Wall Street built a financial weapon, pointed it at the world, and pulled the trigger. The story doesn't start on Wall Street. It starts with the American dream, the dream of owning a home. In the early 2000s, banks, politicians, everyone wanted more people to buy homes. So they made it easy. Too easy. They created the subprime mortgage. A prime mortgage is a safe loan given to someone with a good job and good credit. A subprime mortgage is a risky loan given to someone with a bad credit history or no job at all. Lenders were giving out millions of these liar loans with no verification. The question was, what do you do with all of this risky, toxic debt? This is where Wall Street got creative. They didn't want to hold these risky loans, so they bundled them. Think of it like a fruit salad. The banks took one rotten apple and mixed it with 99 good apples. Then they packaged this salad, put a fancy label on it, and sold it as a delicious, safe investment. This was the mortgage-backed security. But they didn't stop there. They then took all the worst parts of all the fruit salads, bundled them together again, and sold that as a new investment. This was the collateralized debt obligation. It was financial alchemy, turning garbage into gold. And Wall Street made billions selling this toxic garbage to the world. But wait, you ask, who would buy this toxic garbage? They bought it because of the rating agencies, companies like Moody's and Standard & Poor's. Their job was to be the watchdog, to investigate and rate investments from AAA down to junk. The problem? The rating agencies were being paid by the very banks they were supposed to be rating. Lehman Brothers would pay Moody's millions to rate their CDO. So, what did Moody's do? They took that toxic, rotten apple fruit salad and they stamped it with their highest, most perfect rating, AAA. It was the exact same lie as Enron's auditors, a fatal conflict of interest. At the center of this hurricane was Lehman Brothers and its CEO, Richard Fuld. His nickname was the Gorilla. He was the longest tenured CEO on Wall Street, and he was arrogant. He believed in the Enron model. He pushed Lehman deeper and deeper into the toxic subprime market. In 2006 and 2007, as the first warning signs appeared, Fuld ignored them. He doubled down. He believed Lehman was invincible. He believed that if they ever truly got into trouble, the U.S. government would have to save them. He was too big to fail. He was wrong. By 2007, the dream was over. House prices, which had only gone up, suddenly stopped, and then they crashed. All those subprime borrowers who couldn't afford their loans started to default. The rotten apples were exposed. The AAA mortgage-backed securities were worthless. In one weekend, in September 2008, the US government called all the Wall Street CEOs into one room. AIG, Bear Stearns, Merrill Lynch, they were all dying. But the weakest was Lehman Brothers. The government made a choice to save the others. They had to make an example of one. They let Lehman fail. On September 15th, 2008, Richard Fuld watched as his 158-year-old company died. The failure of Lehman was not the end. It was the beginning. It triggered a global panic. The stock market collapsed. Credit froze. The entire global financial system stopped to prevent a second Great Depression. The US government was forced to do the unthinkable. A $700 billion bailout for the very banks that had caused the crisis. They did save the world, but they also saved the criminals. It was the largest transfer of wealth from the taxpayer to the private sector in history. In the end, the Madoff scandal and the Enron scandal both had a clear conclusion. CEOs like Bernie Madoff and Jeff Skilling went to prison. But for the 2008 financial crisis, the crisis that lost 9 million American jobs and destroyed the global economy, not a single major banking CEO and went to jail. The banks, as Richard Fuld believed, were too big to fail. But the bankers were apparently too big to jail.